Ladies and gentlemen, good day and welcome to the PNGS Reva Diamond Jewellery Limited Q4 and FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shuyar Samant from Stellar Investor Relation Advisors. Thank you and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us today. We have with us today the senior management team of PNGS Reva Diamond Jewellery Limited, Mr. Amit Modak, Whole-time Director and Chief Executive Officer, and Mr. Aditya Modak, Non-Executive Director, who will represent PNGS Reva Diamond Jewellery Limited on the call. The management will be sharing the key operating and financial highlights for the quarter and full year ended 31st March 2026, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements that are completely based upon the company's beliefs, opinions, and expectations as of today. These statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statements to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Amit Modak. Thank you and over to you, sir.
Yes. Good afternoon, everyone. You must have gone through the results which are uploaded on the stock exchange website. It was our first full financial year after incorporation, and FY25 restated was there. Now this FY26 is a purely complete year we were operating, and complete year without having any restated or that kind of adjustment or regrouping. These financial results are there. Our investor presentation has been uploaded on the company's website just now, so you will go through after this our meeting. You can refer it through our website and stock exchange links. PNGS Reva Diamond Jewellery is a branded certified natural diamond jewellery built on a strong legacy of PM Gadgil with 190 plus years trust, creditability, and deep industry expertise. We have a strong presence in Western India, particularly in Maharashtra, along with an expanding retail footprint across the key markets. With the current store count of 36 stores, out of which 2 are the COCO stores and 34 are SIS, we are evolving aspiration of modern consumers through a well-curated portfolio of natural diamond jewellery across price points. Our product basket spans from the entry-level offering of 15,000 to 35,000, aim at customer acquisition, to everyday wear between 35,000 to 1.5 lakh, which drives the repeat purchase. This is complemented by our core occasion wear segment, ranging from 1.5 lakh to 5 lakh, and further extended to our premium and signature collection priced from 5 lakh to 25 lakh. This structured portfolio enables us to cater to diverse customers and their needs for the occasions, while also creating a strong lifestyle play within a single brand, driving higher wallet share and repeat engagement. We believe diamonds are increasingly becoming relevant across occasions, ranging from daily wear and work wear to celebration, weddings, and gifting. Their versatility, timeless appeals, and improving affordability are expanding usages of occasions and driving higher purchase frequency. When we say that it is becoming relevant across the celebration, wedding, and gifting, we mean the natural diamond only, because those can be inherited and it creates value and wealth. From a customer proposition standpoint, we complement our product strength with strong customer-friendly policies. A key differentiator for us is our robust buyback and exchange policy, where we offer up to 90% diamond price in case of buyback and 100% diamond value in case of exchange sale. For the gold which are attached to it and in which it is traded, the price has got very much transparent because it is on the public domain, and we offer that for the exchange, whatever selling buying rate difference is there, we charge for the buyback. This enhanced customer trust provides liquidity, flexibility, and positions diamond jewelry not only as a discretionary purchase, but also a strong store value, thereby encouraging repeat purchase and a long-term customer relationship. From a distribution perspective, we operate a retail-led model supported by discipline and scalable expansion strategy. Our two-format approach, comprising shop-in-shop with our parent company, PN Gadgil & Sons and their ecosystem, and exclusive brand outlets, which are called EBOs, exclusive brand outlet, enable us to effectively balance capital efficiency with brand building while maintaining a strong operational control. This is an asset-light, low capex, vanilla model across both the formats. These models support higher return on capital employed. The model ensure capital efficiency, lower execution risk, faster scalability, while also provide clear visibility on growth through steady growth of the store addition. As of now, we have established a strong and focused regional presence across 3 states and 25 cities. These 3 states are Gujarat, Maharashtra, and Karnataka. 1 store is at Gujarat, 1 store at Karnataka, and remaining are in 23 cities of Maharashtra. With a higher concentration in western part of the country, this regional focus allows us to develop a deeper understanding of local consumer preferences, tailor our products offering accordingly, and drive higher conversion and repeat purchase. It also enables us to optimize our supply chain, reduce logistic costs, and improve inventory turn, thereby enhancing overall operational efficiency and profitability. Company has got plan to add 15 new stores, which is very well mentioned in DRHP, RHP, and prospectus, out of which 1 store is already established, and overall this expansion of 15 stores will take place in a 24 months period. Remaining 14 stores, as 1 store is already established, are planned across India with a strategic focus of Tier 1 cities, while selectively expanding into Tier 2 and metro cities to strengthen brand presence and expand market reach. Supporting this next phase of growth, capital is raised through the IPO, wherein company raised 380 crore. Out of that, 287 crore proceeds are earmarked exclusively for the store expansion working capital requirement. In addition to that, 35 crore are selected for the IPO, out of the IPO proceeds for marketing and promotional activity for these 15 new upcoming stores. This calibrated deployment of capital providing strong visibility on growth while ensuring disciplined execution and scalability of our retail network. I would like to briefly touch upon the broader industry context, referring to CARE report published in November 25. The Indian Gems and Jewellery Industry. This report page is included in our report also, presentation also. The Indian gem and jewellery industry is a large and growing market, currently valued at approximately 10,000 plus billion rupees and projected to grow around 15,000 billion rupees till by calendar year 29, driven by the rising income, better credit access, and changing lifestyle. This growth is underpinned by strong structural tailwind, including rising disposable incomes, increasing urbanization, and evolving customer preferences, particularly among the younger demographics. At the same time, we are witnessing a clear shift from unorganized to organized, branded and certified player, from family jeweler to branded jeweler. As consumer increasingly prioritize transparency, quality assurance, and trust, additionally, the growing acceptance of diamonds across occasions, coupled with an expanding gifting culture and higher purchase frequency, is further broadening an addressable market. Backed by this favorable tailwind, along with our differential business model, strong parentage, and scalable retail strategy, we believe PNGS Reva is well positioned to capitalize on this opportunity and deliver sustainable long-term growth. With that, I would like to move to the operational highlights for the quarter and financial year 26. Our inventory turn are at 1.31 times in FY26. As our store network continues to mature, we expect this metric to further improve over a longer term, driven by healthy same-store sales growth and operating leverage benefits arising out of the economic of scale. Further, our average order value as far as FY25 was concerned, it was 85,000. As far as current year ending for which we are referring the results, that is FY26, the average bill size value or average order value is a 1,20,000. YOY growth is 41%. Financial highlights Q4 revenue from operations stood at 138 crore, registering growth of 139% YOY. Gross profit for quarter stood at 38 crore, reflecting growth of 195% YOY, with gross profit margin at 28%. EBITDA for the quarter stood at 31 crore, recording growth of 278% YOY. While EBITDA margin stood at 22%, profit after tax stood at 21 crore, growing by 350% YOY, while PAT margin stood at 16%. Coming to FY26, we will be comparing FY25 restated financial because we incorporated company in FY25 during December 2024. So fractional period was there, but we have presented restated figures in DRHP, RHP, which you can refer. So coming to FY26, we will be comparing it to the FY25 restated financials, starting with revenue from operations, which stood at 439 crore compared to 258 crore, reflecting growth of 70%. Gross profit stood at 122 crore, with a gross profit margin of 28%. EBITDA FY26 stood at 95 crore, registering growth of 19% YOY, while EBITDA margin stood at 22%. Profit after tax for FY26 stood at 65 crore, reflecting growth of 9% YOY over FY25, while PAT margin stood at 15%. Wherever we are referring FY25, please note those are restated. By leveraging our strong legacy, disciplined retail execution, and focused positioning in premium diamond jewelry segment, we aim to further strengthen PNGS Reva as a trusted and aspirational brand within India's organized jewelry market, while consistently creating sustainable long-term value for all stakeholders. With this, we would like to move to the question answer, and everyone is most welcome for questioning, and I am very much interested in answering your question. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harsha from Meritus Advisors. Please go ahead.
Yeah, hi sir. Congratulations on the great set of numbers. I just wanted to ask a couple of questions. Can you give some color on your store economics, that what kind of revenue per store you are expecting and what kind of footfalls among 30 store-in-store shop-in-stock we have? Can you give a little bit color on the store economics? And I'll ask second question post you answer the first question.
Store economics for SIS, that all infrastructure is provided by PNGS, who are having those FOCO kind of the franchisees, where franchisee are having operational part, while company has got inventory and employees part. So their operational cost, we are not knowing exactly per store, but we are paying them commission on the sale which is happening in their location, and those commissions are different. For diamond, there is a different percentage of commission. For making charge, there is a different percentage of commission, and on gold there is no commission. But on vanilla basis, if we see that every rupee sale, we are paying them 4 paisa, or the 4% of the sale which is happening there on a vanilla basis. And if we refer to the SSG kind of the thing, the last year we have seen SSG of around 40% in the existing SIS. I'm considering SIS FY25, there were 30 SIS. FY26, there are 34 SIS. So 4 SIS are added, of which 1 SIS was added in last month of the year. So for that single SIS which is added at the end of the year, there was no much sale, but those 30 SIS which were there in the start of the year, the top line was around 313 crore in last year. That is FY26. Store economics for the EBOs, there is a store economics like around 6 lakh rupees a rent, 3.5 lakh rupees a employees cost, 1 lakh rupees a hospitality cost, 1 lakh rupees a infrastructure running cost. Expecting around 9 crore rupees top line per store, that is a 75 lakh rupees per month or 3 lakh rupees per day, making with our that average bill size of 1,20,000 around 2.5 to 3 customers per day. That is reasonable for 0.75 stock turn, because around 12 to 15 crore rupees inventory will be there in each EBO. At 0.75, top line will be around 9 crore, and it will go on increase through the SSG over a period, which generally get escalated to 1.25 in period of 3 to 4 years time. So on 9 crore rupees, whatever gross profit margin we are making right now are around 30%. We can take it as around 2.7 crore rupees as a operational profit. From that, if we calculate that all these different costs which I have told you amounts to around 1.5 crore rupees a year, giving EBITDA level absolute rupee of around 1.5 crore rupees per year at the initial stage. And when we reach to 1.25 or 1.5 kind of the stock turn in 3 to 4 years time, that EBITDA level 1.5 crore will reach to around 3.5 to 4 crore rupees somewhere between. So that is for EBOs. When EBOs are within Maharashtra, we are expecting this kind of working to achieve that 0.75 kind of stock turn in 9 to 12 months. When it will be outside Maharashtra, we are expecting it within first 18 to 24 months.
Okay, so that was very much helpful. And can you give some color on how the EBOs or the company-owned, company-operated stores will be structured? Whether you'll buy the property or you'll take it on lease? Like there will be some...
Those will be asset light. We will never buy the property. It will be on rented lease.
Okay, so it will all the lease liability will all be reflected in the finance cost, right?
Yes, and that restated balance sheet shows the future liability also by capitalizing. So that lease liability is there, but that liability means the future rent which is payable for the period of that agreement.
Okay, sir. Thank you. That was helpful. I'll join back the queue. Thank you so much.
Okay.
Thank you. Next question is from the line of Priyanshu Maheshwari from Holani Ventures Capital Fund. Please go ahead.
Hello, sir. First of all, congratulations for your excellent numbers. Sir, could you share your expectation regarding the customer acquisition cost over the upcoming quarters, and what are your revenue expectation and overall breakdown timelines for new stores?
No, customer acquisition cost as such, we are not calculating it, because it is very difficult in our kind of business. We are not running any scheme or anything like multi-level marketing kind of thing where we can calculate the customer acquisition cost. Customer acquisition cost is nothing but our goodwill, which is working very well. Mouth-to-mouth publicity, BTL activities, ATL activities, those kind of activities we carry out, and the publicity which we normally make. Through the schemes, we can acquire the customer, but also we are reluctant to run these kind of schemes also, which are having cross-marketing kind of the thing, because our is a luxury kind of the industry and discretionary purchase, so these kind of activities are not supposed to be there. What was your second question, sir? Please repeat.
Sir, what are your revenue expectation and overall break-even timelines for new stores?
In earlier reply, I said that within Maharashtra, if it is 0.75 stock ton, if I want to achieve, it will take around 9 to 12 months or 8 to 12 months time. And that gives me 1.5 crore rupees EBITDA level margin per store. And if it is outside Maharashtra, it will be 18 to 24 months time. And the revenue growth for EBOs, as I said in earlier questions reply, from 0.75 stock ton to reach to 1.25 to 1.5 kind of the stock ton, with the EBITDA level expected around 3 to 3.5 crore rupees per store. It takes around 3 to 4 years time.
Okay, sir. Sir, my other question is that in your recent interview with NDTV, you emphasize focus on the natural diamonds and concern about resale value. Sir, with the rapid growth of lab-grown diamond, do you see them as a long-term competitive threat? And how are you adapting the Gen Z and millennial customers which have lower purchasing parity and view diamond more as a lifestyle?
Right now, I think that lab-grown diamonds are there in market for at least last 6 to 7 years time. In last 6 to 7 years time, people have seen the change in price. It is I will not pronounce whether it is a positive or negative, market knows it very well. But for natural diamond, we are looking to 3 to 5% appreciation year over year. And recently, one very good national level brand has introduced the lab-grown diamond stores outlet, where they are explaining to their customer that there is no resale value to the lab-grown diamond, and there is only resale value to the gold content in that ornament. So it is very much clear in the market that there is no resale value or buyback value for the lab-grown diamond. So with our buyback policy, natural diamond has got rarity and increasing value over a period. So I'm not thinking that is a threat for me. And secondly, even though millennium are there, we have got 150 crore plus population. Out of that, high level higher middle class and white collared class millennium are also there, who will prefer to the natural diamond because it has got resale value, so they can exchange it in future because they will be having repeat exchanges and repeat visit to the shopping because they have got additional discretionary or reasonable discretionary surplus which they can use it repeatedly. At that time, if there is a resale value, they will prefer for that. And as it is in our society, whenever we give some ornament in the wedding or the anniversaries, those ornaments, it carries the wealth, not only the look or the lifestyle. Because if if father is giving gift of the necklace to his daughter in marriage, he cannot give the lab-grown diamond necklace to his daughter. Because when that daughter will carry that necklace, it should have inherited value. She should transfer that property or value or the wealth to her son, means to her daughter or daughter-in-law in future. So generally we inherit wealth, and natural diamond is getting classified in the wealth. Not lab-grown diamond is getting classified in the wealth.
Okay, sir. Thank you very much, sir, for your answer.
Thank you. Before we take the next question, a reminder to all the participants, if you wish to ask a question, please press star and 1. The next question is from the line of Rishabh Doshi from Nirmati Investment Advisors LLP. Please go ahead.
Yeah. Hi. Congratulations on a great set of numbers. I had 3 questions. So the first question is there some accounting difference between the gross margin or EBITDA margins between the current financial numbers and the restated ones? Because the EBITDA margins have come down from around 32% to 22% in this year?
See, up to last year, it was not a separate entity, so certain fixed costs were not there. Like, premises we taken on the rent for separate sitting, then inventory and logistic department was created. Then there is a CEO, CFO, compliance department. So all these costs have gone up because of the separation. Earlier, it was a part of the main entity, and that's why there was no such cost which were borne by the this division. Now, because these costs are there, then earlier there was no interest cost also there. But since you are talking about the EBITDA, that doesn't matter. So these separate costs which have got loaded, that has reduced the EBITDA margin.
Okay. So in the long run, this margin of, let's say, gross margin of 28%, EBITDA margin of 22%, like, this would be sustainable, right?
Yes. Gross margin may improve in future because right now we are not charging any brand value in the diamond pricing, which is valued or the price just like a family jeweler price them, like 35% gross margin loading. But over a period, we will start loading the brand value once our brand gets settled in the market, because this industry has got gross margin between 30 to 35% or even as high as 40-42% also. So right now, these margins are without loading the brand value to the diamonds.
Okay. Also, like, could you give the breakup of the raw material between, let's say, gold, diamond, and others, which might include platinum?
The platinum is a very smaller content in the total sale, but gold and diamond, if we consider even as a jewellery, 1 lakh rupee jewellery contains around 50-55% of the gold and 30-35% of the diamond, and 15% to 20% of making. That is a composition right now in present days, because gold prices have gone up. Earlier it was a gold contents were 15 to 20% and diamond contents were around 60-65%.
Okay. So like if gold prices go up, let's say like 30% in one quarter, on a totality basis, like, would you expect gross margins to contract?
A gross margin percentage basis it may contract, but in absolute value it will get maintained. And as a person, I more believe in the absolute value rather than percentage.
Okay. Because other, I guess, plain jewellery companies like even though gold prices go up, their margins.
We are not comparing ourselves with the plain gold jewellery company.
Okay. Since we have excess gold, like, which is mostly through buybacks or exchange, like, where do we sell this, and why don't we keep it on our balance sheet? And do we also have inventory gain in gold?
No, we never calculate inventory gain as such, because we are valuing our inventory at average purchase price, not at FIFO or LIFO. So inventory gain or inventory loss concept is not there. Our inventory is getting valued at average purchase price, which is far less than the current market price at present. And generally, it is a competitive to the current market price because it is an average purchase price.
Okay. So the excess gold, like, do we sell this to like gold traders?
Nowadays, what is happening, people are giving gold even as a consideration also. If somebody is buying 3 lakh rupees necklace, he may come with the 20-gram gold coin, which is valuing around 2,80,000, and will pay over and above that 20,000 by credit card. Then that 20-gram gold comes in my kitty, which is a part of consideration. So I need to encash that. Unless I encash that, my working capital will get stuck, because that 20 gram is not my intended purchase or requirement. It is received as a consideration. Instead of bank, I am receiving the commodity in my hand. And that is sold in the market directly in an open market. And that sale is mentioned as a note in the accounts regularly.
Correct. Thanks. And my last question is like, our sister company, Gargi, like they are also into diamond jewelry, but the difference is that they sell it with 14K gold. So my question was like, doesn't this lead to kind of conflict of interest? Like we are selling almost the same thing. The difference is that we are selling at 18K or 22K and they are selling at 14K. So, but at the end of the day, the product is same. The average ticket size is also in the same range. So my question is, why do we have such a structure?
See, there are biscuits available in the market, which are normal biscuit, gold biscuit. Means I am talking about the confectionery and bakery product biscuit. Product is same.
Correct.
One manufacturer is selling 3 kind of glucose biscuits. One in pack of 4 biscuit, which are extreme premium glucose biscuit. One in a name as a gold, which is a second level premium, and which is very ordinary, which is in a yellow kind of the packing. So product is same. So in Gargi, we are selling 14 karat gold along with lower quality of the diamond. I am saying lower quality with not mentioning that those diamonds are fake or anything. Diamond quality always get assessed with the color. So in Reva, we are selling E and F color. That is next to highest color. D is the highest color. E and F color. And good 4 Cs. All 4 Cs are extreme good. In Gargi, we sell HI. And with good 4 Cs, but color is HI. So their valuation, their prices are different than the valuation and prices of the Reva. So Reva is a premium thing. Gargi is a daily wear and pocket friendly. Secondly, they have got range from 10-15,000 to 2,25,000 kind of thing. In my earlier comment to start with the meeting, I said we sell from 15,000 to 25 lakhs. So it's a nose pin to bridal jewelry. That bridal jewelry kind of necklaces or sets are not there in Gargi. So it's some mainly fast moving fashion jewelry along with having resale value diamond jewelry.
Okay. Yeah. Thanks. That's all from my side.
Thank you. Next question is from the line of Shubhanu Bangal from Three Capital. Please go ahead.
Yeah. Hope I'm audible.
Yes, you are.
Yeah. Sir, can you tell me what was the buyer growth in FY26?
What was?
Buyer growth.
Buyer?
Buyer growth.
No, I'm not getting exact. Can you?
I'm explaining. Like FY25, 100 customer was buying. But FY26, how many customer bought from us?
Bought from us?
Buyer growth.
Buyers?
Yes, buyer
number
growth.
Of buyers?
Yes.
Number of buyers, that statistics is not with me. You can send a separate mail. I will forward it to you on the mail. There is a CS or the compliance mail ID is there. On that mail ID you can send. Because it is not readily available with me right now.
Okay. Okay. Sir, my next question on SSG. You said FY26 SSG was 40%. Do you expect this will maintain?
I hope so.
Okay. And my last question on store opening. Out of this 15 store one store already opened. And how many store will be open in FY26?
We have
FY27?
2 EBOs are there. Out of that, 1 EBO is post IPO. So 15 EBOs we are planning through the IPO proceed. Out of that, 1 is completed. Remaining 14 are there. Out of these 14, 6 to 7 will take place in current financial year. And remaining will be in next financial year. Because we have mentioned in DRHP, RHP prospectus that this is a project for 24 months period.
Yeah, but as 6 to 7 store will be open in FY27, then automatically our inventory turn will be reduced because a new store inventory turn will be low. Is my understanding correct?
No, inventory stock turn right now is mainly used in the SIS. SIS is amounting almost 350 crore rupees top line. These
Yes.
new EBOs will have comparatively lower inventory content as compared to the present 330 crore rupees inventory, which is already in the system. And secondly, their top line will have around 0.75 kind of the stock turn. So this 1.3 stock turn will get improved from the SSG also. So it will get compensated from the lower stock turn of the EBOs, which are upcoming. As I said in my earlier opening comment, it's a vanilla model where SIS also working, which are existingly working as a profitable with higher stock turn, and these new EBOs which are coming at initial period, those will be lower this stock turn as compared to the present our stock turn, but it will get compensated and average out. So I am not expecting that much fall in the stock turn as overall as an organization.
We can expect this will be maintained.
Yes, yes. It should get maintained.
Okay.
Hardly मतलब ये 1.31 है तो वो 1.25 से लेके 1.35 के बीच में हो.
Understood. Sir, my last question on margin. As you said, कि हमारा margin भी gross margin यहाँ से बढ़ सकता है, but this will be happened in FY27.
See, I am for all listeners, I have got a very precise thought process that I don't depend more on the percentage. I depend more on the absolute value. Because if gold prices keep on going up and gold content in total sales goes on because of the gold prices, on gold there is a lower margin, percentage term I am talking about. But as a absolute value of the margin or the rupee of the margin, it will get maintained or increased. And so there will be net increase in my earnings, even though not in percentage term, but in value term, it will definitely increase.
Okay, understood. Thank you, sir. Best of luck.
Thank you.
Thank you. Next question is from the line of Harsha from Meritus Advisors. Please go ahead.
Yeah, sir, I just wanted to ask that what are your expectations in terms or outlook or for in terms of revenue for FY27, 28 and triple SG, if you can also give a outlook on that.
SSG I am expecting around 25 to 30%. It will not be less than 25 to 30%. I achieved it 40% last year because there was a all of a sudden shoot up of the gold prices. So in value term that it is there. But if gold prices remain stable, I am expecting 25 to 30%. But if gold prices shoot up just like last year, it again can match with the previous year's SSG growth.
And sir, revenue and can you give an outlook on revenue for FY27, 28?
If SSG growth is there, and as I said very precisely, major turnover for coming 2 years will be from this SIS mainly. So SSG is mainly on the SIS plus upcoming stores. So I expect top line growth also to get maintained around 25 to 30%.
Okay. And, you might have heard the current announcement as well, sir. There might, do you expect any pressure on gold going forward? And because of that, there might be a, pressure on our top line as well, right?
No, it may, if import duty is increased, then it may increase the gold prices in Indian context. It cannot put pressure or it cannot defer the decision of the buyers If I want to buy a gold chain, I will buy gold chain only. If I want to buy gold studded with the diamond, I will buy gold studded in the diamond studded in the gold. So
Okay.
price of gold may change if government change some structural import duty, custom duty, GST and all these things. That direct indirect tax loading may change on the product. But I don't think that government will ban importing gold or do anything kind of rationing or anything, because we are in the free economy. Government will not demonstrate any such thing which will give the demonstration of the restricted economy kind of thing. We are in the free market.
Okay.
And
Okay.
since it's a discretionary purchase, generally people who are liking the luxury, having higher middle class and rich class of the people, they will not mind to pay something more due to change in import duty and all. Because it's a statutory thing. It is not something different for showroom to showroom or brand to brand.
Okay. Okay. That was very much precise, sir. Thank you so much.
Thank you.
Thank you. Next question is from the line of Divya Daga from Volta Green Structures Private Limited. Please go ahead.
Hello.
Yes,
Hello.
you're audible.
Yes.
Hi, sir.
Right.
I just have, as majority of our revenue comes from 34 SIS stores. So I want to know how our parent company is planning to expand those stores further.
Their expansion is out of their accumulated profit. That is internal accruals. They are not borrowing additionally. So their growth will be 3 to 4 stores in 2 years, every 2 years. So it will be a passive expansion mainly for us, because we have started on the EBO model, and that EBO model starting is mainly to avoid that passive expansion, because they require 90 crore to 120 crore to set up one store, which is a very high capex, and they don't want to borrow further. So it depends on their internal accruals. But when it's a EBO which we are setting, it requires around 20 to 25 crore rupees per EBO. So that expansion will have better numbers at lower capex.
Okay. Thank you so much, sir. That's all I have.
Thank you. A reminder to all the participants, if you wish to ask a question, please press star and 1. We will take our next question from the line of Lokesh, an individual investor. Please go ahead.
Hello. Thanks for the opportunity. Sir, my question is, let's say in the next 24 to 30 months, we will have somewhere near close to 50 stores. So what could be the revenue potential that you can see in those 50 stores, let's say in the year FY28 or FY29?
Yeah, I have given a matrix for per store revenue top line. You can multiply it, because I cannot spell out you precise revenue projections and all this. And I have said that 30% SSG growth is likely from these 34 existing stores. And I have given you idea that around 350 plus crore rupees revenue is there in current year from these SIS. So you can escalate the figure and calculate on yourself what could be the 2 years on this 34 store with 350 crore base with 30% escalation every year, and at 9 to 12 crore rupees top line for these 15 store in next 2 years. First year it will have 7 to 8 store. Next year again it will have 7 to 8 stores. Because giving you forward-looking statement precisely in rupee, there are certain limitations.
Okay, sir. Thank you.
Thank you. Next question is from the line of Rahul Kumar Paliwal from Shifa Family Office. Please go ahead.
Good afternoon, sir.
Good afternoon.
Yeah. Congratulations for great set of numbers. So my first question is, what has actually driven this growth for this year compared to the last one, where we jumped from 250 CR, 8 CR to 440 CR? Hope I have not missed some clarification already, which you have given.
See, the growth is a focus. Concentration on certain business makes a difference altogether. We have demonstrated in our other listed company also that after separating out it as a brand and given concentration on that, we have exponentially grown from 15-20 crore to 140 crore kind of the thing in Gargi Fashion Jewellery. Here again, the separating out the business and creating a brand is with the same vision to concentrate on the product line, to give a more and more designs and concentrating on the variety, finish and everything. So this is a focus activity or the things which are done with the focus target that has materialized and given the numbers which are right now in front of you. Those are 439 crore, but out of that, almost I think 55 to 60 crore is the around 55 crore is that surplus gold which we are receiving. Otherwise, that is around 390 crore rupees, which is a B2C purely jewellery.
Got it. So I think conservative side, you spoken about 25 to 30% top line growth. While what is the margin profile in this business we wanted to maintain for medium to long term, say let's say 3 to 5 years. And my second question is about now both these verticals like Reva and Gargi has been listed. So what exactly is the management thought process to streamline the executive leadership, for example, CEO to both of the entities and the leadership and streamlining the operations, maybe the listing onto the main board of Gargi and all the corporate actions, which is actually derived from when we grow from very a baseline and then the things takes place down the line 3 to 5 years, the growth and everything is visible through this executive machineries. So what are the strategies on that front? Like have you thought about full-time CEOs on the verticals and so on, so forth?
So for Reva, there is a CEO, CFO, CS, everything is in place. Full-time director is in place. In Gargi, CEO is not there, but it will take care by that company in due course. And they have already started working on it. But for Reva, I don't think that there is any lagging or the shortcoming in the top level management. And as far as compliance levels are concerned, even though Gargi is a SME, we are complying just like a main board. We are having quarterly filings, declaration of result on quarterly basis, and corporate governance is I think it's reasonably good in the industry. We complete our AGMs and all these things before 31st July every year, and generally declare result in first or second week of May every year for the financial year ending, and quarterly results also within 35 to 45 days every quarter. So as far as compliance and all these things, I don't think that there will be any problem at present and in future also.
It was more about the related to strategic, like the management bandwidth dividing in between two entities and all, but I got the broad idea. My last question is about growth. We have taken the growth capex from the market, which is almost like a PE investor kind of growth. We have given a chance to retail to participation. So I'm assuming at least for 2 years we don't need the funds. Down the line, 2 year and 3 year, maybe, what would be your mode of getting the growth capex? Like, would it be a further equity dilution, or it will be internal accrual and the cash flow we generate from in these 2 years from the existing setup?
See, this year we are adding almost 64 crore out of the earnings. So those internal accruals we are retaining, we are not distributing. So in next 2 years also, I expect some these kind of numbers will come and which will get added to the internal accruals. Further, we have got 190 crore rupees loans which are in place. Over and above, there is a 50 crore rupees sanction received from ICICI Bank and 40 crore rupees sanction received from SVC Bank. So another 90 crore, making almost 280 crore, out of which I am using right now around 130 to 150 crore somewhere. So existingly also there is a sufficient almost 150 to 200 crore rupees unused sanction limit. And moreover, these sanction limits I can get even a higher sanction limit in future because my financials will be strong, my equity, other equity will be very strong, that parameter and ratios will be very strong, debt to equity and all these things. So I don't primarily expect any dilution of the equity, but after getting settled by 2030, I will be expanding out of the borrowings in future.
Great. So that's no equity dilution for investors. So I think the capital, the management bandwidth, the plan is in place, and now we wish you for the execution. All the best, sir.
Yes, thank you.
Thank you. Next question is from the line of Subhanu Bangal from 3 Capital. Please go ahead.
Yeah, thank you for follow-up. Sir, as you mentioned, 6 to 7 stores will be open in FY27. Out of that, how many will be open outside Maharashtra?
It will be one or two. Two stores will be out of state, and 5 will be in Maharashtra, because we have repeatedly saying that 40%, 60% will be the ratio for these 15 stores. 60% will be in Maharashtra and 40% will be outside Maharashtra, more preferably in north part of the India, Tier 1 city and in the mall.
Yeah, and outside Maharashtra, store takes around 18 to 24 months for break even.
Yes.
And normally how much inventory you are keeping?
8 to 12 months.
Yes. And normally how much inventory you are keeping store level?
Store level inventory depends on the size of store, from 1,000, 1,200, 1,500, three type of model, that is a small, medium and large. Small require around 9 to 10 crore rupees, medium require around 12 to 15 crore rupees, large require around 18 to 20 crore rupees.
And first year inventory turnaround 0.75.
I am expecting 0.75 in Maharashtra in first year, but it will be at end of the year. At initial 4 to 5 months, it may be 0.25%, 0.25, 0.3, 0.5. So it will be incremental. To reach that 0.75% base level, I will take 8 to 12 months in Maharashtra.
And outside Maharashtra?
18 to 24 months.
Okay. Thank you. That's it. Best of luck, sir.
Thank you.
Thank you. Next question is from the line of Priyansh Miri from NTP Family Office. Please go ahead.
Actually, my question was already answered, but sir, any trend that we see in working capital before your stable state 2030 timeline? Like, will it the overall working capital for the business will remain steady, or do we see any reduction by 2030?
No, as number of stores goes on increasing, that back-end inventory requirement goes on decreasing. If I am right now maintaining around 15 to 20% back-end industry inventory, then number of stores, it grows, that may percentage-wise go down to the 12 to 15%. And to that extent, there will be lesser working capital requirement may be there.
Understood, sir. Sir, also one more question on your marketing side. Like, given that we are planning to expand outside Maharashtra, right? So, is there any already planned budget that we have allocated for marketing expense that could hit on our margins?
No, for every location, whether it will be in Maharashtra or outside Maharashtra, for every EBO we are planning to spend around 2 crore rupees, and that will be spent between 12 to 18 months period, not at a stretch. एक साथ खर्चा नहीं होगा. So that spend will be planned for the BTL activity, ATL activity, social media activity, that kind of the things. It will not a bulk spend, and it will be targeted region-wise or area centric. And brand as such, we will be spending around 3 to 4% every year on the top line.
Okay. So long-term margins, sir, will be maintained between 19 and 23% only, right?
Yes.
Given any volatility in gold and everything, right?
Yes, sir. See, moreover, I am always saying that absolute value, it will be growing, because if gold content increases, that percentage may decrease, because on gold content, that margins are not like a diamond margin. If diamond content is high, then margins are very high. But when gold content goes on increasing in the total composition of the ornament, then margin may fall, but value-wise, rupee term, that profit will increase.
Okay. One last question, sir. I joined late, so I'm not sure if you already answered this, but do we also hedge our inventories on, do we already actively manage our inventory by using hedge?
See, I have got gold through the slum sale. And in slum sale, that gold was attached to the jewellery of the diamond. So, hedging it through the bank, not possible. Hedging through MCX is possible, but there is no liquidity, and cost of hedging is very high on the MCX. Secondly, up to 2004, there was no hedging mechanism. People were still carrying out business very healthy and profitably. We have got 190 plus year experience of the business. And in this business, as much as you sell, you should cover immediately on the same day at same price. That is the best mechanism of the natural hedging. And that is there. Plus, we are having surplus gold in our system. So we sell that gold from time to time to B2B basis, because that gold is received in form of consideration. If somebody is buying 3 lakh rupees necklace, he may come with the 20-gram coin and remaining amount through the credit card. That 20-gram coin is received instead of bank receipt. So I need to encash that, otherwise my working capital will get stuck. So buying fresh gold from the bank is a very rare event, but still I have got limit from the Federal Bank and HDFC Bank and ICICI Bank for buying gold through the GML. Whenever I will require to buy fresh gold from the market or the bank, I will prefer to go for the GML.
Okay, sir. Sir, also one more question, have you also shared any guidance on the product mix? The diamond jewelry will become what percentage of overall revenue in next 2 or 3 years?
In which concern? Because we are doing exclusively diamond jewelry. We have got no mix of the plain gold jewelry or anything. And platinum jewelry is there, but that platinum jewelry is a very minor part of the total jewelry.
Majority it will be studded part.
Majority it will be studded. Gold means 18 karat gold studded.
Okay, sir. Thank you for the.
Do you want to know about the product wise or the gold and plain gold and diamond, that kind of thing? Otherwise, rings is the highest sold product in my composition, which is almost 28%. Then studded Mangalsutra with the pendant, diamond pendants and all these things, that is around 25 to 27%. Then earrings, kaan ke jhumke, that is around 15 to 17%. Necklaces are 10%, and so on. Bengal bracelets are 5 to 6% each.
Okay, sir. Sir, also some of our competitor, they also mention where they're strategically focusing, right? Like lightweight jewelries or lesser of a traditional design, right? Our focus will be more, I think, on the lighter part of the jewelry segment, right? A smaller ticket item, focusing more on the new generation, right? That is the correct understanding, right?
No, any studded jewelry means trader. All these branded jewelers are selling mainly in the range of somewhere 70,000 to 1,50,000 kind of jewelry. And heavy jewelry consists part to the extent of 10 to 15% of their total top line. Lightweight is concept in the pure gold. Lightweight is not concept in the diamond jewelry. And in the diamond jewelry, there's trendy designs is trendy, which cost around 1 lakh, 1,50,000. Heavy design will be around 5 to 7 lakh. Medium size designs will be around 3 to 5 lakh.
Okay. So our focus will be on the same range, right? 1 to 1.5 like average selling price.
Our average bill size or average order size is 1,20,000. But we cater from 15,000 to 25 lakh kind of jewelry. We sell the bridal jewelry necklaces also, diamond necklaces, or the kangans, which are studded with the 30 cent or 20 cent kind of diamond on the kangan. And those are sold as a bridal jewelry.
Okay. So, sir, where are we focusing? Like more on the higher cost items or like lower side of
No, in
ASP?
percentage-wise, that higher price item comes around 10 to 12% of the total sale.
Okay.
And medium size comes around 20-25%, and lower ticket size or the pocket-friendly items comes around 60 to 70%.
Understood. So going ahead, also I think it will remain same, right? Given our brand positioning, right?
Yes.
Yeah. Okay. Okay. Thank you, sir, for answering the question.
Thank you. Next question is from the line of Harsha from Meritus Advisors. Please go ahead.
Yeah, sir, just one question. Can you also, you already have given the EBO revenue run rate. Can you also give the SIS run rate going forward of the 33 SIS that we have?
No, SIS are of different size, because if my parent has got 6,000 square feet showroom, then he provide me around 700 to 800 square feet area. If he has got his location of just 2,000 square feet, I will have area of around 100 to 200 square feet. So every SIS will have a different kind of top line. We need to take it on as a whole, all together. If you say 350 crore rupees in 34 SIS, then it will be around 10 crore rupees per SIS. But that doesn't hard and fast matching, because my few SIS are working between 20 to 40 crore rupees per year.
Okay, sir. Thank you. That's it from my side. Thank you so much.
Okay.
Thank you. That was the last question for today. I now hand the conference back to Mr. Amit Modak for closing comments. Over to you, sir.
Yes, thank you very much to all who have joined and participated in this discussion. I hope we have answered reasonably as per expectation of the listeners or the participants. Thank you joining us today, and expect your continued support. As always, we have received in past also. We remain available to address any follow-up questions. Please feel free to reach out us directly or through our investor relation partners, Stellar IR Advisors. Thank you.
Thank you very much, members of the management. On behalf of PNGS Reva Diamond Jewellery Limited, that concludes this conference. Thank you for joining us today, and you may now disconnect your line. Thank you.
Thank you.